Hello there, everybody, and thanks for watching. I'm Sam, and I moderate these weekly webinars for 3M employees. Welcome. In just a minute, we'll be joined by one of our senior advisors. His name is Tyson Mavar, and he's going to be breaking down whether or not you should take the lump sum or the annuity when you retire from 3M. Before Tyson comes on, though, I'd like to quickly remind you that although we work very closely with both active and retired members of 3M, the retirement group is not affiliated nor endorsed whatsoever by 3M. We are a completely independent group of financial advisors here. Please keep that in mind as you listen along with him today. Afterwards, I will jump back on with him to ask him some of the questions that came through the Q&A box. I invite you to stick around and listen for those if you're interested. And if you happen to see any YouTube cards popping up anywhere above my head here throughout the video, please feel free to click on those. They will guide you to some different resources that we offer you here at the Retirement Group. One may be a past video of a topic you might find of interest or concern as a 3M employee. Another may be a link to book an appointment with either Tyson himself or one of his colleagues after this video has ended. So take advantage of those. And without further ado now, I am going to turn off my camera so Tyson can get started. Hi, Tyson.
Hi, Sam.
Hey.
Thanks for the introduction, and thank you folks for attending our webinar series today. My name is Tyson Mavar. I'm one of the retirement specialists here at the Retirement Group. And today what we're going to be talking about is really one of my favorite topics because it tends to be one of the most important decisions my clients from AT&T make, which is how to take the pension. And not only how to take it, but when to take it, which is very critical in maximizing what you walk away from the company with. So let's get right into it. Now, the lump sum has been popular for a number of years, and it still remains popular in this rising interest rate environment, but it's not the only option. And oftentimes we see people overlooking all of the various pension benefit options that they have. Some of the various annuity options can sometimes make sense. And I just had a very good meeting with one of my clients earlier today who will be retiring later in the year. And it's not an easy decision, but it's probably one of the most important ones for most people at AT&T because it's irrevocable and it's going to have an impact both on your lifestyle in retirement, your cash flow, and also potentially your estate. So we find it important to spend a lot of time on this topic before somebody retires, well before they retire, ideally. And we have a cash flow analysis that we've developed in part to help to identify what's likely going to be a better outcome given some certain assumptions about life expectancy, internal rates of return. And then the more we talk to our clients, the more we can identify what's important to them. Is it helping family members, whether it's children, special needs family members, spouses? Is risk tolerance a factor? Somebody who's more conservative might have a different ideal pension benefit option than somebody who is maybe more aggressive. So all of these things play a role, and this is why we find it important to spend time communicating with folks to get to know them and hopefully shed some light on what's likely going to allow them to have a more comfortable retirement and reduce the probability of regret in retirement based on such a big decision. The single life annuity is actually the default payment option, and it is the option that all other forms of payment are derived from. So your pension formula, whether you are Legacy T, SBC, Hackbell, regardless of your heritage with the company, this is going to be the option by which the lump sum is derived, as well as the joint survivor annuity options are derived. But it's going to be the largest monthly income stream, the largest possible monthly income stream you could receive, but it's only good for one lifetime, only yours as the retiree, which is why it ends up being a larger payout option. Now, the company will use both interest rates as well as life expectancy to evaluate some of the different pension options like the lump sum, like the joint annuities, and the life expectancy potentially of your spouse or your joint annuitant if you decide to go with the joint annuity on your pension. So very common for single people with no beneficiaries or no interest in leaving money to somebody. Common for people with very great health, longevity in their family, someone who intends on and plans to live a very long life. Sometimes more appropriate for somebody with lower risk tolerance that doesn't have interest in figuring out how to invest a lump sum of money. Annuity option could be just a simpler option. And there's a variety of reasons that people might consider this based on their personal circumstances. Also, some that people might not consider taking this, such as the willingness and ability to defer income. Somebody maybe that's going back to work after they leave AT&T, they might consider taking the lump sum just so they can invest that money and earn interest on it until they need the money, rather than getting money that they have to pay taxes on that they don't even need because they have another job. So there's a lot of factors in this decision, but we find it helpful to run a cash flow analysis and really start to understand how these various options might pertain to your specific situation. Joint survivor annuity, similar to the single life annuity, although this is good for 2 lifetimes, typically spouse, but doesn't always have to be. And there's going to be reductions depending on which joint annuity option you take. For example, if you take the 50% joint survivor annuity, your spouse or your joint annuitant will receive a reduction of 50% when you pass away. If you go first, they'll get half as much as you are getting during your lifetime. But the reduction during your lifetime won't be as bad. It won't be as big of a reduction as if you were to, for example, take the 100% joint survivor annuity, where your spouse or your joint annuity would have no reduction in their income. You're just going to have to pay for it in the early years of retirement by a reduced payout. Now, most of these options also have what's called a pop-up provision, and you'll notice this, and there's, as many of you probably know, close to 20 different pension plans at AT&T, and the benefit options aren't the same in all of them, but they're pretty similar. Pop-up provision means that if you take a joint annuity option, but you, the employee or retiree of AT&T, dies first, of course, your joint annuitant is going to receive that annuity. But what if your joint annuitant dies first? You're actually going to get an increase in what you were reduced by during the rest of your life. So let's say you took the 100% joint survivor and maybe you were getting, let's call it $4,000 a month rather than $5,000 a month for life because you decided to take the joint annuity. Well, if your spouse or your joint annuity goes first, they will pop you back up to that $5,000 a month single life annuity that you would have originally received had you taken the single life annuity. So good to know. It's not free, by the way. You're paying for that by a reduced benefit on these joint annuity payouts, but certainly something to consider if you're worried about being stuck in that lower payment for the rest of your life, or maybe your spouse has an illness that you're not certain will make it to a life expectancy that would be ideal. These are good things to know about. Now, lump sum, very popular. This is where you get what the company believes is the actuarial equivalent of your lifetime of annuity payments all upfront as a lump sum. If you roll that money over, you don't have to pay taxes on it immediately. There's a few exceptions to this for very highly compensated employees that have a non-qualified portion of their pension. Most people we work with are able to roll over most of their lump sum, if not all of their lump sum, and pay zero upfront taxes. That money could be rolled over to your 401k. It could be rolled over to an IRA. Variety of reasons you might consider both of those options that we'll talk to you about when we do your cash flow analysis. And the goal is to invest that money in such a way that it helps to fight inflation, so it grows to keep up with cost of living over time. It's not at too much risk or too volatile, but it's a supplement to what you saved in your 401k plan. And that money is safe in such a way that you're not increasing the probability of running out of money in retirement. In fact, the goal of that is the opposite, is to ensure that you don't run out of money by investing it appropriately and by earning a certain rate of interest and having growth on your investments that will make sure that you do not outlive those assets in retirement. One of the bigger benefits that I've seen people attracted to on the lump sum is that if they suffer an untimely death, or if they just don't spend all the money, they can leave that money to a non-spouse beneficiary or even a spouse beneficiary more flexibly than they could by taking the joint annuity. There's some other benefits some people are concerned about. Where's AT&T going to be? Although there is some insurance on the AT&T pension annuity through PBGC, Pension Benefit Guaranty Corporation. There's less control when you take the annuity of what happens to that money. For many people, had a lot of questions last year when the company sold off. I think it was close to 25% of their pension liabilities to an insurance company called Athene. Many people did not think that was even a possibility and had some questions on it. So we hear a lot of questions related to this, and they're very fair to ask, especially before the month that you are retiring, which unfortunately is when a lot of people start to ask these questions. Ask questions now, start doing the planning now. That way your decision making process is a lot less stressful once you get to the point where you're leaving AT&T, picking a pension option. And oh, by the way, the company has been doing layoffs a lot for the last 10 plus years. So not everybody gets to pick their retirement date, unfortunately. That is the worst case scenario in my experience working with people, is being forced to make a lot of these decisions under the duress of also having lost your job and trying to figure out what you're going to be doing for income within the next 6 months. Do the planning up front. It's going to save you a lot of stress. I'm very confident. A lot of people ask us, why, when interest rates go up, does the lump sum go down? And the best way that we found to answer this is comparing it to mortgage payment. So let's say you find out that you can afford a mortgage payment of $19.50 a month, and current interest rates are, let's say, 4%. Now we're probably laughing now because most people can't qualify for a mortgage under 7% right now with recent interest rate hikes. But let's just say it's 4% for a 30-year fixed. The bank or lender is willing to loan you $408,500 as a lump sum. So the annuity or the payment would be $19.50. The lump sum would be just over $408,000. What if interest rates drop to 3%? Nothing has changed to your annuity or your payment that you can afford, but now the bank's willing to lend you more money because rates are now lower. The opposite would be true. If interest rates went up, the bank, and this is what we found for a lot of people in the last couple of years, banks are willing to lend people less money. So most people either have to take on a house that is worth less in their minds than they could have afforded a couple years ago, or they've got to come up with more money. And just a lot of people have been kicked out of the housing market as a result of this in the last couple of years. But the same applies to present value calculation when figuring out how much of a lump sum the company has to give you, given a certain life expectancy, but also given a certain anticipation of what you'll be able to invest that money at for the next 30 years potentially of your life. Now, the last thing we want to talk about is this look back period, which is how the company looks at the interest rates to calculate a lump sum. Uniquely, AT&T locks in their interest rates for 1 year. Many companies do quarterly or monthly changes to the lump sum interest rates, but AT&Ts are good for a full year. As a result of this, though, the interest rates happen to fluctuate to a pretty large degree on that date, which is January 1st, that they change the interest rates because of how much time has elapsed since they last changed the rates. The month that is relevant for AT&T, both management and non-management, is November. They're going to use the November corporate bond interest rates to calculate the entire next year lump sum recipient's pension plan. So right now in 2024, they're going to be using November of 2023 interest rates. This is important because as we get to the end of the year, we can figure out if you're going to make money or lose money on your lump sum based on what's happened throughout the year to interest rates. And this is also not only important on the timing of your retirement, but for most employees, you can defer the election of your pension. You don't have to take your pension the day after you retire. This is not the case with everybody. For example, some non-management plans will force you to take the lump sum within 90 days. If you are over age 65, you have to take the lump sum as of the next available commencement date after you retire. If you're under 65, for many employees, you can wait a couple months or even a couple years in some cases could be advisable to take your pension, whether it's because you're seeing some good guaranteed growth on that money in the pension plan versus what you could get outside of the pension plan, or because we see where interest rates are going and you're anticipating a larger payout if you wait a couple months. That's the most common reason people will defer their pension. So very important to watch these interest rates closely. We actually have the recent ones here. November, of course, is the rate that everybody is using if they take their pension out this year, whether or not they retired this year. But they update these rates monthly on the IRS website, and we track these throughout the year so we can try to give good advice to our clients. And we were fortunate to see a little bit of a dip in rates from October to November, It was actually a pretty substantial dip for a 1 month period, which helped people's pension payouts. But most people saw a reduction in their lump sum again in January of this year, not quite as bad as the reduction that most people saw in January of 2023 because of how much rates climbed in 2022, but still a little bit of a reduction. Although we're watching rates very closely, it has been suggested that the Federal Reserve would like to cut rates this year, although inflation numbers are going to have a very big role in whether or not that is done. And as it turns out, the rates that the Federal Reserve controls are not the rates that affect your pension. And there's actually times when corporate bond interest rates are rising at the same time short-term federal funds rates are falling. So you can't always listen to what the Federal Reserve is talking about anyway, but stay tuned. We'll be updating everybody throughout the year on what's happening with these rates and what's happening to the pension plan as a result. Like to bring this up on every one of these webinars. We found that statistically 74% of Americans over the age of 50 don't even have a written plan for their retirement, which we think is crazy as retirement advisors, just because we know how important this is and how many mistakes are made when people haven't thought about some of these decisions ahead of decision-making time. We're happy to do this for you on a complimentary basis, whether or not you're deciding to become a client or even considering becoming a client. We offer to do this for everybody for free at AT&T, at the very least to improve our reputation within the AT&T community so that we can continue to get referrals from folks and continue to grow our business. So let us know if we've never done this for you, if you have interest in having us run your cash flow analysis, a critical step in the retirement planning process, in our opinion, or even if it's been a year or more that we've updated yours, let us know so we can get it updated because a lot's changed in the last 12 months. We want to make sure that your plan accounts for some of the changes that have happened to the retirement tax code, as well as the changes to the benefits plans at AT&T. With that, we are going to open it up for questions, Sam. We have a little bit of time, so I will take a few if we had any come up on the call.
Ooh. Thanks, Tyson. Yes, let me focus my camera. There it goes. Alrighty. Yes, let's answer just a couple questions. We'll keep it short. This first one, when I retire, is it possible for me to defer receiving my pension until later when the rates drop?
Yeah, and I probably answered that right after
Yes,
you
you just
asked the
did.
question. But yes, in most cases, the exceptions are which plan you're on. Some pensions don't allow you to defer the lump sum for very long. And if you're over 65, you most likely can't defer it at all. So call us and we'd talk to you about your specific situation, whether or not that's a possibility.
Thank you for that. Okay, number two, is it possible to take both a partial lump sum and an annuity?
In some cases, yes. Good question. Some managers have a partial lump sum with residual annuity. I don't see that as, and that used to be the only lump sum option for managers until I think it was 2015. They offered full lump sums to all managers. Another consideration, this is what I talked about earlier with one of my clients, was if you don't have a partial lump sum or one that meets your income goals and your legacy goals, you could take the full lump sum and then use a portion of that lump sum to purchase your own annuity that might be more specific to your needs and values, such as having a cash refund. If you pass away, you can leave money to kids and things like that, or having an inflation hedge or the ability to invest that annuity, which is not the case with the AT&T annuity. So there are options available for really picking how much lifetime income you want, and then the rest you can invest, for example, rather than just being stuck with the all or nothing option of full lump sum or full annuity that AT&T has chosen for you. There's definitely some options with that.
Alrighty, thank you. Last one. Actually, before I ask this question, I want to just remind everybody that after this webinar has ended, you will be redirected to our homepage where you can book an appointment with Tyson or one of his colleagues. You can also take advantage of other resources that we have available on our homepage, excuse me. Alrighty, Tyson, is there a chance I'll run out of money if I buy an annuity?
There's always a chance you could run out of money. Nothing is risk-free. In the sense that if you're comparing AT&T's annuity on your pension to you taking the lump sum and going to buy an annuity, there's different risks associated with that. I talked a little bit about the risk of AT&T going out of business. Similar risk if the insurance company that made the guarantee to you goes out of business, and there's reinsurance through both of those, right? We talked about PBGC, and then the insurance companies have various reinsurance options or securities for those folks that are buying annuities from them. That's your advisor's job, by the way, to look at the different insurers and their ratings and maybe consider multiple insurers so you can not have all your eggs in one baskets, if you will. But never say never. There's always risk, regardless of what you're looking at. So it's just really about what your values are, what your risk tolerance is, what your concerns are. Those are things that whoever you work with, whether it's us or one of our peers in the industry, need to communicate about so that everybody can be on the same page and a solution is offered to you that's consistent with your goals, objectives, and concerns.
Alrighty, Tyson, that was it for today. Anything else you want to mention before we go?
I think that's it, Sam. Thanks for the help today. Thank you all
Of
for
course.
attending our webinar series. Have a great rest of your week. We hope to see you all again very soon.
Thank you, everybody. Bye-bye.